welcome to our quarterly market update. Once again, I'm joined by Dr. Steve Garth from our investment committee. Welcome, Steve.
Yeah, thank you, Rob. Great to be here.
It's been an interesting 12 months, Steve. Markets seem to be doing well across the globe. In particular, Australia. What has happened in Australia in this first half of the calendar year and this last quarter?
Yeah, look, it's been a pretty good first half of the year, Rob. The Australian market's up by 4.4%. Now, to be honest, it's been a bit of a flat quarter, so a lot of that gain happened in the very first quarter of the year. But the 12 months return, because the rally has started way back in October, the 12 months return, the Australian stock market's up by 14.4% for the year. So really good return, 12 month return.
And what about developed markets and emerging markets? How have they fared in the last 12 months?
Well, let's start with the developed markets because they are the standout asset class this quarter, or this year actually. So you can see here that the developed markets ex-Australia, they're up 17.5%. Now the developed markets are mainly the US, it's about 65% of the market. And you can see on the slide there that that's the top performing market. But you'll see that it's broad across countries as well. Europe is doing well, who would have thunk with what's going on in Russia. And Japan is doing well, and who would have thunk, because Japan's economy is always kind of stagnant.
Yeah.
So you can see that the boost to international markets is really happening across the board, particularly in the US. And you asked about the emerging markets, that's not doing so well. And that's because about 30% of the emerging markets represents China. And despite China coming out of those COVID lockdowns, the economy really hasn't kicked on the way many people thought it would. So the stock market there is actually a little bit negative for the year, and that brings down the whole of the emerging markets.
Okay. You would have had to have been living under a rock not to hear about the AI craze. Have markets been driven by this, or what impact has AI had on the markets, particularly in the US and the NASDAQ?
Yeah, well, you're absolutely right. In fact, this has been driving the markets. We talked before that the US was the best performing market, which drives everything else really. But if I break down the US, Robin, in this slide we're looking at the S&P 500, that's the index that most people would have heard of. It's made up of companies from two different exchanges. One is the New York Stock Exchange and the other is the NASDAQ. And you can see in the chart here that the New York Stock Exchange, it's kind of just bobbing along a little bit like Australia. But the NASDAQ stocks, well, they're up over 30%. Now, that's being driven by only 7 companies. They're called the Magnificent Seven. It's Apple, Microsoft, they're the top 2 companies. And the third company, and the one that's really had the standout, is a company called NVIDIA, which most Australians would not have heard of a couple of weeks ago. Yeah. But NVIDIA's up 180% this first half year. It makes semiconductor chips, and in order to power AI, you need Apple and Google to make the interfaces, but you need the chip maker to give you the hardware.
Yeah. And rates, interest rates. The Reserve Bank has recently met and decided to put rates on pause. What can we see going forward? Can we expect them to go down, go up, remain where they are?
Well, we've got some handle on that when we look at yields. I know yields are not everyone's favourite topic, but you can see in the chart here, it's the Aussie yield curve, and then under that we're putting the returns of the global bond index. Now, what you can see is that yields are slightly going up, particularly in the last quarter. In the first quarter, they went down with the bank collapses, but now they've been climbing back up. And that's the bond market trying to work out where is the terminal rate? Where's this going to end? Yeah. Now the answer is we don't know exactly where, but we know it's not far away. So there was a pause by the RBA yesterday, but they've left the door open for a rate rise or 2. In the US, back in June, they had a pause, but the Fed chairman made it clear that he expects another 2 rate rises. And the bond market's kind of doing that. It's just inching up a little bit. So the answer to your question is the terminal rate is close. We're not far away from the end, but we're not there yet. When you look at the returns, you had a positive return in the first quarter from bonds, which was welcome. Tiny negative return this quarter, just because those yields have climbed up again.
Yeah. And the dreaded R word, recession. Are we heading for a recession? Is it going to be a soft landing? What's the expectation there?
Yeah, so look, the markets are giving us mixed messages here, Rob. The equity market is saying, I know the terminal rate is close, and then it's all going to be good, and we're all fine. And so volatility is its lowest for years, but the equity market keeps going up, so that's positive. The bond market is the yield curves become inverted by the end of this year, meaning that the bond market is expecting a serious slowdown in the economy. Now, no one's going to deny that the economy is slowing, and the question is, how fast will it slow? The equity market seems to think it's going to be a soft landing. The bond market is probably leaning more towards a hard landing. We won't know the answer to that for another couple of months.
We never do.
Mixed
messages.
It's mixed messages.
Okay, well, thanks very much, Steve. Thank you all for watching, and we look forward to seeing you next quarter.
Yeah,
Thank you.
Thanks, Rob.
Cheers.